Welcome back to Nomad Investing. Today we're taking a look at Pfizer, ticker PFE, one of the largest pharmaceutical companies in the world. Most people know Pfizer as the company behind the C-19 vaccine, but its business goes far beyond that. With drugs spanning oncology, immunology, cardiovascular and rare diseases, Pfizer remains a global healthcare giant. Here's what makes Pfizer stand out right now. The stock trades at a forward PE of just around 7.7, which is extremely cheap compared to the broader market. And it pays a massive 7% dividend yield. Pfizer is still investing heavily in the future, recently spending $10 billion to acquire Metsera, a cancer-focused biotech company that also has a promising weight loss drug candidate in development. If successful, that could give Pfizer an entry into the booming weight loss and diabetes drug market, currently dominated by Novo Nordisk and Eli Lilly. But the big question is Pfizer a bargain hiding in plain sight, or is it a cheap for a reason, with declining COVID revenues and patent expiration weighing down the future? Stick around until the end, because we'll cover Pfizer's business overview, financials, future opportunities and risks, and finally my valuation and thoughts on whether PFE is worth buying today. Overview. Pfizer is a pure global biopharma company with operations in more than 125 countries. It develops and markets medicines and vaccines across oncology, immunology, and etc. While Pfizer gained worldwide recognition for its C-19 vaccine, the company's long-term strength lies in its broad pipeline and established drug portfolio. Right now, Pfizer has over 80 approved drugs and vaccines on the market, and more than 90 projects in clinical development, including 25 in phase 3 trials. This wide base helps diversify its revenue streams, but there's still a big challenge ahead: the patent cliff. Several of its blockbuster drugs, including Eliquis, Ibrance, and Xeliance, will lose exclusivity by the end of the decade. If those drugs were to lose 100% of their current sales to generics, it could wipe out more than 15 to 20 billion in annual revenue, which is roughly a quarter of Pfizer's total sales today. Of course, the reality is usually more gradual, but it shows the scale of the risk. This is why Pfizer has been aggressively pursuing acquisitions, like the recent purchase of Seagen and Metsera, and investing heavily in the late-stage pipeline to offset those looming losses and position itself for future growth. Financials. Let's look at Pfizer's numbers. Forward adjusted EPS is about $3. That gives Pfizer a forward PE ratio of around 8. While its trading PE on unadjusted earnings is closer to 14. Either way, that's cheap compared to the broader market. Dividend, Pfizer pays around $1.70 per share annually, which is around 7% yield, one of the highest among big pharma. The dividend has grown for 14 consecutive years, at a 5-year growth rate of roughly 3.5%. and should remain safe unless something drastic happens. Market cap is around 140 billion, with some short interest in the stock. Now let's check the revenues. Revenue per share peaked in 2022 at more than $18 during the COVID boom, but has since fallen back to around $11, showing little growth overall. EPS tells a similar story. $5.5 in 2022, then collapsing to below $2. So similar to revenue, there's no real growth here. Margins have compressed sharply. Pfizer's profit margin was above 40% in 2021, but dropped into single digits and then stabilizing at 25 to 30%. Debt sits about 56 billion in long-term borrowings, balanced by nearly 90 billion in equity. Capital returns haven't been impressive, especially compared to peers. So overall, Pfizer's balance sheet is solid and the dividend looks somewhat reliable. but earnings have collapsed since the COVID windfall and growth looks flat at best. That's really the key story behind the stock right now. Future. Let's start with the opportunities. Pipeline strength. Pfizer has more than 90 projects in clinical development, with 25 in phase 3 trials. Success here could mean a new blockbuster drugs. mRNA technology. The company is working on flu and RSV vaccines with mRNA technology, potentially creating another long-term revenue stream. Aging population. Demand for cancer, cardiovascular, and immunology drugs will keep rising as populations age globally. Risks. Patent expirations. Major drugs like Eliquis face looming patent cliffs. If replacements don't launch fast enough, revenues will keep shrinking. Fading COVID revenue. Pandemic vaccine and treatment sales have collapsed from the peak levels, and it's unlikely they'll return. Debt and lower returns. With debt above 50 billion and declining return metrics, Pfizer is less efficient than before. Competition. Other pharma giants like Merck, Bristol Myers, and Novartis are also pushing hard into oncology and immunology. Intrinsic value. So, what is Pfizer worth? Pfizer's forward adjusted EPS is around $3, while the unadjusted figure is closer to $2. With the upcoming patent cliff expected to weigh heavily on revenues, but also a pipeline of new drugs in development, I think the two forces may roughly balance each other out, or potentially tilt slightly negative. Because of that, I'm going to take a conservative approach and assume 0% EPS growth in the near term, followed by a modest 2% growth rate in line with inflation over the next 5 years. Pfizer currently trades at a forward PE ratio of around 8. Compared to the S&P 500's forward average of around 18 to 20. Historically, Pfizer's PE has reached as high as 75, with a long-term median around 18. That means today's valuation is among the lowest in the company's history. Given Pfizer's status as a blue-chip pharmaceutical company, but also factoring in the upcoming patent cliff, and the uncertainty around how quickly new drugs will offset those losses, I think it's reasonable to expect a more conservative PE multiple of around 10 over the next decade. If we calculate using the non-adjusted EPS, which in my mind gives a better estimate in actual profits, because Pfizer adjusts these profits every year so much. With these numbers, the intrinsic value would be around $19 per share. But with adjusted EPS, it's around $28. If the pipeline delivers and earnings rebound more strongly, the upside could be substantial. Conversely, if the new drugs disappoint, patent expirations hit sales hard, or the dividend is cut, downside risk remains significant. Here's my conclusion. Pfizer has moved past its COVID-era boom. Near-term earnings growth is likely to be slow or flat. The core investment thesis is now a value proposition based on its generous 7% dividend yield, strong balance sheet, and low valuation. This is fundamentally an income stock. However, this high yield carries risks. The dividend could be vulnerable if the upcoming patent cliff on unpatented drugs creates a deep revenue hole. For the patient, income-focused investor who trusts the safety of that dividend, the strategy is clear. Collect the quarterly payments and wait it out. The potential for significant capital gain, even doubling your money, comes if and when a new generation of blockbuster drugs achieves peak sales and re-rates the stock from, example, 7 PE to 15 PE. That moment of peak sales is your clear sign to sell for maximum profit. If you're seeking for immediate high-octane growth, Pfizer probably isn't the right fit. If you want to get paid high, somewhat reliable dividend today, while owning a long-term call option on possible future growth and a PE re-rating, Pfizer is an appealing play where it trades today. Despite the appealing risk-reward balance, especially for an income investor, this stock is pass for me. Ultimately, I'm sticking to my lane. Biopharma falls outside my current circle of competence. And as always, this is not financial advice. Do your own research before investing. If you enjoyed this analysis, hit the like button and subscribe so you don't miss my next video. And as always, do not lose money and safe travels. Bye bye.